Okay. So now looking at volatility index, one of the things that we can see looking at volatility index is that the market is currently trading within a bullish channel, right? The market is currently trading within a bullish channel. So if you can go on MetaTrader, you will see that it is still trading within this bullish channel. So on a weekly time frame and also on a daily time frame, you can see that it is still trading within a bullish channel. So upon trading within a bullish channel, one of the things that you can actually see when it comes to volatility index is that when it comes to volatility index, before you can start making any or placing any positions, long positions or short positions, there's something that you have to wait for, especially when you are analyzing using the MetaTrader platform, right? So what you need to do is actually wait for the market to gap up or down, depending on which positions you're looking to take, whether you're looking to take long positions or short positions. So what we have seen is that we have seen that gap to the upside. So you can only see it on a daily time frame, and also you can only see it on the MetaTrader platform, the binary MetaTrader platform, right? So if you can look through historical data, that's something that you can see more often. Whenever the market is about to shift in direction, what it does is that it will form a gap first. Right? This is something that you should be in a position to actually know. You can actually see it. So this is kind of like a hint when it comes to a shift in direction. So this is actually a hint. So the market actually hints to you that, like, okay, now we have exhausted the long positions, or we have exhausted the short positions. So now there is a shift in order flow is upon us. So we can be in a position where we can start looking for potential shorting opportunities. Are we okay on that? Where did you try to place your positions and you got stopped out? Where? That's the thing. Like, you have to have a place. Like, you can't. The thing about like volatility index is that it's not the same as currency. So you cannot use session timing in order for you to make your executions, right? So you literally have to be in a position where you time, because if you try to use session timing, it won't work out well, because like this one, at any point it starts moving, right? So right now, this is one thing that we can deduce from this chart, is that like every time the market is about to shift in direction, what it does is that it starts by forming gaps initially, right? So that's one thing that we have seen now. So again, one thing, let's go on this, right? So right now, we're currently seeing that the market has formed a gap, right? So we have this gap that is yet to be filled. Just because you see the gap doesn't mean that you're going to automatically just make execution. Oh, okay, it's basically okay. I understand now. Just because you see this gap doesn't mean that you're just going to enter short positions and just like let it go down, right? So the thing about it is that, like, before the market can come back to fill that thing, it can make a bit of an extension, push a bit further to the upside. As you can see here, we have that gap here that has formed. We have this gap that was formed initially. But look at how long the market stayed away from it ever since it was created. 1, 2, 3, 4, 5, 6, 7. 1, 2, 3, 4, 5, 6 days before it came back to fill it. Can you guys see this? Right? So you can just like put short position because you want the gap to be filled. Remember last week what we spoke about? We spoke about that there is no duration in which the gap needs to be filled. Remember that we spoke that when it comes to gaps and tail, the market doesn't have a specified time limit in which we're like, oh, okay, this is the right time for it to be filled. It's not the same as on currencies. On currencies where like the gap, if it's created within the first hour, it must be filled within the first hour, or else the market is going to be away from it for a period of like a week or more. Right? It's not the same as supply and demand, whereby when we're talking about supply and demand, we have a certain time limit, right, where we can determine the supply and demand zones validity. And we say, okay, it's valid provided that the market stays, provided that the market doesn't stay away from this zone ever since it was created for more than 30 days, for more than 24 hours, for more than 5 days, for more than what do you call this, for more than 920 something days, 900 days, right? Are we okay on that? So again, the other thing that we can see on this, is that irrespective of whether we had this push to the upside, the other thing that we have to do is that we have to firstly deduce in which phase are we currently trading within, right? Because each and everything that you're doing, you need to be in a position where you identify where are you currently trading, in which leg are you currently trading within, right? Because we saw that we had that impulsive phase, right? We had that impulsive phase, we had a corrective phase, right? We had the last leg of the impulsive phase pushing price to the upside, right? So within that last leg of the impulsive phase that pushed price to the upside, what occurred is that we had what? An impulse, a correction, and we can actually say that this is the last leg of the impulsive phase, right? So again, now we have that impulse, the correction here in the form of a consolidation, and we're currently trading within the last leg of the impulsive phase. But with that being said, again, what do we have? We have an impulse, a correction. We're currently trading within the last leg of the impulsive phase. Are we okay on that? Are we okay on that, guys? So we identified the micro and macro 3 cycles that makes up a wave, right? So now what now that we have deduced this, right? Now that we have deduced this, we have deduced the fact that we had that impulsive phase, we have the corrective phase. We're currently trading within the last leg of the macro 3 cycles that forms a wave. And we know that we're currently trading within the last leg of the micro. Remember, these are two. There's macro, which means bigger, and micro, which means smaller, right? The inner and the outer, the inner, the outer, the inner, the outer one, right? So basically right now we understand where we're currently trading. So now let's go deep and then understand when and where to place a trade, right? So we have seen the gap to the upside, but even though the market gapped to the upside, remember, this is still a daily time frame. So we have yet to see a reversal, right? So let's go on a 4-hour time frame. So one thing you realize is that like when you move to a lower time frame, that gap disappears, isn't it? Can you see, guys? There is no gap anymore, right? We have that impulse, the correction, the last leg of the impulsive phase. We have that impulse, the correction, the last leg of the impulsive phase. And within that, we have the impulse, the correction, the last leg of the impulsive phase. And within that, we had the micro one. Let me draw the micro one. Okay. We have what? The impulse, the correction in the form of an asymmetric triangle, and the last leg of the impulsive phase pushing price to the upside. So within this last leg of the impulsive phase, what did we have again? We had what? We had the impulse, the correction. We're currently trading within the last leg of the impulsive phase. So this is the micro one. So the question now arises, is this leg completed? Let's do this. Remove all drawing. So look at this, right? We have the impulse, the correction in the form of an asymmetric triangle, which is a continuation pattern. And then we have the impulsive phase, right? Pushing all the way to the upside. But like right now, we're going to consider it from this level here. And then we're going to have an a corrective phase. Now we're currently trading within the last leg of the impulsive phase, which is the last leg, right? Can you guys see this? So would you say that right now we completed the last leg of the 3 cycles that makes up a wave, the inner one? Would you say that? Let's do this. Yes, we are currently trading within the last leg. We completed it, right? We completed it, right? So even though we completed it, like I just want to show you something in which how you can approach everything, right? So because we know that we have completed that level, right? We push price to the upside, we have completed that. But if we start applying the Dow theory from this swing low, right? Take it to this one. What does the Dow theory say about this? Right? What does the Dow theory say about this? Right? We're still in a uptrend, right? The Dow theory basically states that the market will continue being in an uptrend up until a recently formed low has been broken. So we have yet to break below any low. So this is our swing low. So this area here, this is our swing low. Right? So this is our swing low. So the market is still considered to be in an uptrend up until a recently formed low has been broken, right? So we have seen the market continuously break above the recently formed highs, but the swing lows, they have yet to be broken. So technically speaking, we're still in an uptrend, but because we have applied certain concept onto this chart, this gives us an insight into where to expect a shift in order flow to occur, right? So where can we expect to take potential shorting opportunities? The other thing that we can see is that like right now, this is a swing high. And if you can go on a daily time frame, I don't know if the daily time frame will show it, but let's do this. Let's just focus on that. Okay. Yeah, that's the problem with this. Like it disappears when you get to a, okay, let's do this. Right? So as it is, where we were looking at the price, right? We are looking at the price from this area here. So where we were looking at the price, most of the traders have gotten into position